Let's start with the basics. Real assets are tangible. You can touch them, see them, and they usually have intrinsic value. Examples: land, real estate, gold, oil, even infrastructure like bridges and roads. Financial assets, on the other hand, are paper or digital claims to ownership or debt. You cannot touch a stock or a bond the way you touch a house. Their value is derived from a contractual claim, like the promise of future cash flows. In short, real assets are physical, financial assets are contractual. Now let's break down the key differences. Nature of value for real assets are intrinsic, tied to their usefulness or scarcity. For financial assets, it's dependent on markets, companies, and contracts. Liquidity. Real assets like land and property can take weeks or months to sell. Financial assets like stocks or bonds, you can sell them in seconds on an exchange. Income generation. Real assets generate income through rent, farming, or commodity extraction. Financial assets generate returns via dividend, interest, or capital gains. Risk and volatility. Real assets are often more stable but less flexible. Financial assets can be more volatile but are easier to diversify. Think of it like this: real assets are the heavyweights, solid and long lasting. Financial assets are the fast movers, quick to buy and sell. For example, let's bring this to life with two investors. Investor A buys farmland. He earns yearly income by leasing it to farmers, and the land value grows slowly over time. That's a real asset. Investor B buys shares in a farming company. Instead of owning the land, she owns a piece of the company that manages multiple farms. That's a financial asset. Both are connected to agriculture, but one is tangible land and the other is ownership on paper. Another example would be buying physical gold bars, that's real assets, and buying a gold ETF, exchange traded fund, financial asset. Now let's weigh the pros and cons. Real assets advantages: hedge against inflation. Land and property usually rise with prices. Tangible gives a sense of security. Lower correlation with stock market swings. Real asset disadvantages: less liquid, harder to sell quickly, requires maintenance and management, higher entry cost. Not everyone can buy real estate or infrastructure. Financial asset advantages: highly liquid. Stocks, bonds, ETFs can be traded instantly. Easier to diversify. You can invest small amounts across many industries. Accessible to almost everyone with just a brokerage account. Financial asset disadvantages: market volatility. Prices can swing daily. Value depends on external performance like company profits or interest rates. Inflation risk. If inflation rises, fixed income financial assets lose value. So which should you choose? The smart answer is both. Real assets bring stability and inflation protection. Financial assets bring liquidity, flexibility, and diversification. A balanced portfolio often mixes the two, real estate or commodities alongside stocks and bonds. It's not about choosing one over the other, but about finding the right mix for your risk tolerance and financial goals. So next time someone asks whether it is better to own a house or invest in stocks, you will know the real answer. They're different tools for different purposes. Real assets are tangible, have long-term value. Financial assets are flexible and have tradable claims. The real question is, what's the right balance for you? If you found this video helpful, hit that like button, subscribe for more financial insights, and drop a comment below on do you prefer investing in real assets or financial assets. I would love to hear your take.